So starting with a new concept, starting with the new concept and the new concept is basically cash management theory. In that we are going to understand Baumol's model. There are two cash management theory that we have. One is given a name as Baumol's model and another is given a name as Miller-Orr model. What kind of say the conclusion that say they have, that is what we are going to discuss. So let us start with the Baumol's model first of all. Dear students, as far as the Baumol's model is concerned, it is say exactly connected with a concept that say we have in costing, which is given a name as economic order quantity. That is a concept which is given a name as EOQ, economic order quantity. This you will be able to understand this cash management theory, Baumol's model, only if your EOQ concept is done. If it is not done, then in that case I request you to learn this theory once your EOQ concept is done. Giving explanation of the same, Baumol's model and economic order quantity model. Basically what happens at say economic order quantity model is having an objective to determine what quantity of raw material to be ordered every time. That is what so the economic order quantity concept has the concept. I give say certain examples to you like this. You don't have to write anything. Let us say that say the 1 year is consisting of 360 days and a company is having annual consumption of the raw material, let us say 360 lakh number of units. So 360 lakhs, 360 days. 360 lakhs, 360 days. So we are having basically daily consumption of 1 lakh number of units. So the assumption is made that so there is a daily consumption of 1 lakh number of units in a way that so the consumption is evenly spread throughout the year. That is the kind of assumption is made. So EOQ concept is having an assumption that economic order quantity concept is having an assumption that consumption of raw material is evenly spread throughout the year. That is the kind of assumption which has been made. Okay. Everybody please pay attention further. Now, the quantity of raw material for which we can place order is, let us say, just I am taking certain assumed values. Let us say that say we are placing order for 30 lakh number of units, we are placing order for 60 lakh number of units, we are placing order for 90 lakh number of units. Based on the quantity for which we place order, we will be having so the number of orders. See what I have written over here. We are having so the annual requirement of 360 lakh number of units. We place order for 30 lakh number of units. Then there will be 12 orders in a year. 360 upon 60, we will be having 6 orders in a year. 360 upon 90, we will be having 4 orders in a year. So if at all we place order for more quantity, number of orders will go down and vice versa. There is a concept that say they have over here, cost of placing an order. Let us say it is an amount of, just I am taking assume value, it is an amount of 1000. Cost of placing an order is consisting of, like basically there is a kind of material requirement requisition, then we are having say the purchase order to be prepared, we are say having a contact with the supplier, whatever this kind of administration or the procedure work which is going on. For that say we have say the ordering cost per order, let us say 1000. So total ordering cost is in the first case 12,000, in the second case 6,000, in the last case it is 4,000. Okay. Now there is a term which is associated with that together, that is called total carrying cost. What do we understand with the term total carrying cost? If at all we purchase more raw material, then in that case what will happen, in our go down we will be having say the more number of units, and with that say we will be having say the more blockage of the funds. You can see that say if at all we place order for more number of units, the total ordering cost is falling down, but in that case what will happen, more amount of the funds will remain blocked in the business. Just I'm taking assume values. Suppose we are having so the carrying cost of one unit as 1 rupee 20 paise. I'm just say taking an assume value. Carrying cost per annum per unit is 1 rupee 20 paise. So what will happen, if at all we place order for 90 lakh number of units, then the total carrying cost will be 90 lakhs divided by 2 into 1 rupee 20 paise. So 90 lakhs divided by 2, 45 lakhs into 1.2, that comes to 54 lakhs. Then 60 lakhs divided by 2 into 1 rupee 20 paise, that comes to 36 lakhs. 30 lakhs divided by 2 into 1 rupee 20 paise, that comes to 18 lakhs. So the total of both of them is the total cost. Like in the first case it is 18 lakh 12,000. In the second case it is 36 lakh 60,000. In the next case it is 54 lakh 40,000. This is what say we understand is the total cost that we have. So basically what will happen, friends, in this situation, as and when you are having say the change in the quantity for which you place order, you will be having say the variation in two things. One is the total carrying cost and another is the total ordering cost. See, on x-axis I am taking the quantity for which we place order, and on y-axis I am taking the cost. What will happen, friends? This is total carrying cost, and this is total ordering cost. So if at all we increase the quantity for which we place order, then in that case the total carrying cost will increase. And if at all if we increase the quantity for which we place order, then number of orders reduces and the total ordering cost also reduces. So this is what we understand is the total cost. This is the point at which we are having so the least expenses. And so this point of the interception is what we understand is given a name as EOQ, economic order quantity. So this is the way we are having so the formulas to be calculated. It is Q divided by 2 into CI and so on. Now we are coming to the Baumol's model. Dear students, the Baumol's model is having certain assumptions like this. First, understand carefully. The assumption is made that annual expense of the company can be, you don't have to write anything, forecasted at the beginning of period, and it is evenly spread throughout the year. That is the first assumption which has been made. Annual expense of the company can be forecasted at the beginning of the period and it is evenly spread throughout the year. Means, let us say that year starts from 1st of April and it ends on 31st of March. Then on 1st of April itself, you will be able to forecast that during this entire year, what will be my expenses. Suppose for example, one year is consisting of 360 days and annual expense of the company is 360 lakhs. So assumption is made which is similar to the EOQ, an expense of 1 lakh rupee will be incurred on daily basis. That is the first assumption that we have. Second assumption is made like this. Whatever the amount that say we are going to spend during the year is available with the company at the beginning of the year. Amount to be spent during the year is available with the company at the start of the year. That is the kind of assumption which has been made. Now, understand carefully, friends. We know that say bank is offering two types of banks account, two types of bank accounts. One they are offering savings account, another that say they are offering is current account. We understand that say if at all, sorry, we understand that say the savings account is offered only to an individual and to Hindu undivided family. For remaining, say it is only the current account. For example, it is a private limited company, it is a limited company, it is a partnership firm, it is a proprietary firm, it is LLP, it is a trust, or you think about any other organization. It is only the current account that they have. Now, whatever the amount which is available with us at the beginning of the year, is it wise to keep the funds in the current account? Please write answer in the chat box. The answer is no. Reason behind that is very simple, that as far as the current account is concerned, current account is offering no interest. We understand that as far as the transactions are concerned, there is no limit. In case of savings account, interest is given. However, the transactions are also limited. So basically what happens, let's say for a company, keeping the funds in the current account in the month of April, which is going to be used in September, October, November, in the next year January, that is foolishness. So we should not make investment of the funds. We should not keep the funds in the current account. So what the company will do, listen carefully. The company will invest entire funds in liquid securities. What does the term liquid securities mean? Liquid securities means those securities which will offer you, say, some specific return without any risk. Mutual fund debt securities are the best example of the liquid funds, wherein you will get some marginal return with no risk. No risk in terms of the principal amount. So what you can do, we can make investment of the entire 360 lakhs, the example which we are continuing, in the liquid securities, and then on regular interval, I repeat that, on a regular interval, this amount will be transferred to current account. For that, so the transfer size is, let us say, 30 lakhs. If the transfer size is 30 lakhs, then number of transfers in a year would be 360 lakhs divided by 30 lakhs. So it will be 12 ones, that is 12 transfers in a year. 60 lakhs, then 360 lakhs upon 60 lakhs. There will be 6 transfers in a year. Let us say it is 90 lakhs, then 360 lakhs upon 90 lakhs. There will be 4 transfers in a year. What I want to tell you is that, say, if at all you have the different transfer size, there will be different number of transfers in a year. Based on that, we will be having total transfer cost. In a way that, say, every time you transfer 30 lakh rupees, say, from liquid securities to current account, liquid securities to current account, then in 1 year there will be 12 transfers. We understand that, say, for example, every time when you transfer the funds, you have cost of 1000 rupees. Then total transfer cost annually will be 12,000. Suppose the transfer size is an amount of 60 lakhs, then there will be 6 transfers, and 1000 into 6. The total transfer cost will be 6000. Over here it is 1000 into 4. Total transfer cost would be 4000. That is what we understand. Now what is the cost per transfer? Let us understand. See, basically what happens at, say, as a student, you may have a point that, sir, what is the cost of transferring the funds from the liquid securities to current account? We would be having an employee to whom we have instructed that, say, you have to do the transfer. So like on the due date or on a specific interval, he will sit on the computer, he will log in, then he will insert the password, then OTP, funds will be transferred, log out, and the matter is over. Where is the cost? See, I agree that, say, there is no out of pocket cost. However, there is an implicit cost for this. The term implicit cost stands for, we are having a cost for doing the transaction in terms of time of the employee, second, infrastructure of the office, third, like the internet that is the charges, fourth, depreciation of the office equipment. That is the way we are having, say, kind of implicit cost. So we would be having, say, the, for different transfer size, the total transfer cost of this amount. Now my question to all of you, please write your answer in the chat box. Between 30 lakhs and 6, that is 90 lakhs, I am tempted to keep the transfer size of 90 lakhs. Why? Because what I can see that the total transfer cost is just 4000. Over here it is 12,000. So I have a temptation to keep the transfer size of 90 lakhs. My decision is correct or incorrect? Please give me reason if at all my decision is incorrect. Friends, we understand that over here, taking just this into account, if at all we take decision, then our decision will be wrong. Simultaneously, we are required to take into account that say what is the carrying cost. We understand that say over here, the on an average unutilized balance in the current account would be more if the transfer size is 90 lakhs. On an average, unutilized balance will be less if the transfer size is 30 lakhs. So the total carrying cost would be more over here and total carrying cost would be less over here. So basically what happens at say, taking just this into account, we should not take decision. Again, we are required to take into account say both of them for the purpose of decision making. So basically friends, as far as the Baumol's model is concerned, Baumol's model is going to help us to make the calculation of economic lot size. It is going to help us say to make the calculation of the economic lot size or the optimum transfer size of the funds at which the total cost is going to be lowest. And for that, we are going to understand the application of the Baumol's model. I request all of you to write down answer along with me. Heading right down. Baumol's model. In that, write down first point. It is a cash management theory that is similar to economic order quantity model. Second point, this model has made following assumptions. In the write down A, annual expense of the company is evenly spread throughout the year. B, amount to be spent during the year can be forecasted at the beginning of year. C, cost per transfer, cost per transfer, in bracket write down O, will remain same irrespective of transfer size. The amount to be spent during the year, comma, rate of interest, comma, cost per transfer will not change. Now assumptions are over. Third point, since amount to be spent during the year is available with the company at the start of year, comma, it will be invested in liquid securities, full stop. Keeping that amount in current account will have loss of interest, full stop. After that, on a regular interval, it will be transferred to current account, full stop. Based on different transfer size, comma, total cost will differ. In that write down transfer size, total transfer cost, total carrying cost. If transfer size is more, then what will happen? On an average, balance in the current account will be more, and total carrying cost will be more. And if at all the transfer size is more, then in that case, number of transfers will fall down. So in that case, the total transfer cost will also fall down. If the transfer size is less, on an average, balance in the current account will be less. and the total carrying cost will also be less. But in that case, the number of transfers will increase and the total transfer cost will also increase. So this is the kind of relationship that we will have. Fourth point, by using Baumol's model, comma, we are going to identify optimum transfer size of funds. That is economic lot size, comma, at which total cost will be lowest. Full stop. I request all of you to draw the diagram. On x-axis we will have this same transfer size. And on y-axis we will have cost. So with the increase in the transfer size, number of transfers will reduce, so the total transfer cost will also reduce. And with the increase in the transfer size, number of transfers will increase. I'm sorry, on an average balance in the current account increases, so the total carrying cost increases. And this is the total cost. Total cost will be lowest when there is an intersection between both of them. That is what we understand. And this is what say we understand is economic. Economic has an English meaning of cheaper, economic lot size. Like we have heard that say when you travel by air, you have an economic class where people like me travel, and business class where people like you travel. Now write down the formula. The formulas are like this. Total transfer cost is equal to A divided by transfer size. That will give us number of transfers into O, cost per transfer. So TTC is total transfer cost. A stands for annual expense. O stands for cost per transfer. Next is TCC. It is transfer size divided by 2 into rate of interest. The term TCC stands for total carrying cost. Total carrying cost. The term ROI stands for rate of interest. 2 is a value only. Friends, over here basically we understand that, say we are having a point like this, that transfer size divided by 2, because on an average whatever the balance that say we are going to have in the current account, only for that the carrying cost will be calculated. The way we have in case of EOQ also, it is Q divided by 2 into CI. And the last is economic lot size. It is calculated as 2 into A into O divided by rate of interest and under root of the same. That is the way we have the economic lot size. I'm just giving an explanation of this economic lot size formula. Economic lot size or optimum lot size, that is one and the same. I'm giving explanation of this formula. Friends, over here the concept is like this. So friends, we understand that we are required to find such lot size at which total carrying cost and total transfer cost are same. So in that case we understand it is in this way: total carrying cost is equal to total transfer cost. Total carrying cost is calculated as it is calculated as transfer size divided by 2 into rate of interest, and the total transfer cost is found as A divided by transfer size into cost per transfer. Now basically what we have to do, 2 is required to be transferred on the opposite side, so it is 2 into A into O. The rate of interest is also to be transferred on the opposite side, so it will go in the division. Transfer size will also go on the opposite side, so it will be transfer size into transfer size. It is transfer size raised to 2. Now raised to 2 is transferred on the opposite side, so it will be transfer size is equal to, it is root of 2 into A into O divided by rate of interest. That is, raised to 2 is transferred on the opposite side, so it become 2 into A into O divided by rate of interest, it's under root. I request all of you to take down the formula at least. This derivation is only for the purpose of understanding. Question number 2A. Consider following information. Annual expense of the company 3,60,000. There are 360 days in a year. Cost per transfer is 500. Rate of interest is 10%. Calculate a total associated cost. Means total carrying cost plus total transfer cost. If the transfer size is 10,000 and if transfer size is 90,000. That is a question. I request you to write down, that is, calculate the answer and put your answer in the chat box.